Hey guys, how you doing? Okay, so I know that there's you waiting. 3, 4. Welcome, welcome, welcome. Thanks for joining me. I just thought we would spend a little bit of time chatting and answering some questions. So, how you guys been? I know that it's end of lockdown, or so it seems, which is great. I'm in the Midlands and it's been chucking it down today. I know that there's been better weather across the rest of the country. So how has it been for you? Let me know in the comments. As usual, I'm literally just gonna stick around here and I'm gonna take questions from you guys. So feel free to ask away. Before we get started though, I do have a couple of things to just, what's going on, Darren? How you doing? Couple of things to, yeah, mate, listen, you boys made it by the skin of your teeth. I'll tell you, I've been watching, I'm a United fan, right? So I've been watching the Leicester match today, and I'll tell you what, I was a bag of nerves. But yeah, I'm happy for Villa because they're just down the road from me. They're not far at all. So it's good to see them stay up. I wonder what's going to happen with Grealish now, though. That's going to be an interesting talking point over the next few weeks as the transfer windows kind of starts to get busy. So yeah, but there are a couple of things I do want to just run by you guys. I might wait for a couple of more people to come on. Just an initiative that I'm running at the moment, which is for a great cause. If you follow me on IG, you've probably heard me speak about it before, but I'm just going to do that very briefly in a moment. Northeast based. Yeah, I am West Mids. I live in Shropshire basically, so I'm not far from Birmingham, but yeah, still out in the countryside somewhere. So yeah, so as always, guys, just taking questions and spending a little bit of time here. The support for the video this week has been really good. Actually, I was actually quite surprised in terms of like my views over the first 48 hours. It is my most popular video so far, and I think that's probably a function of the topic. Obviously, I'm talking about actually picking the stock, which, you know, I've said in the video I was quite reticent to do because people can take it the wrong way, and it's important to know the context or the nuances of what you're talking about in order for you to really kind of know what you're doing. So it's good to know that the support is there. I'll probably make more videos just like that one, just to kind of give you guys a bit more guidance and stuff. But yeah, should be interesting. All right, okay, cool. So let's get going. So if you have any questions, put them in the chat area. I will happily answer them. So a couple of things. So one of my big passions is financial education. You know that if you've heard me speak here on the channel, and you'll know that if you follow me on IG as well. So I have a really big, audacious goal right now to kill 2 birds with 1 stone. So the first bird that I want to kill is providing financial education across a number of topics, key topics that basically empower you guys to achieve life goals, right? So that's really important to me. So what I've done is I'm partnering up with 10 finance professionals. So professionals across personal finance, investing, and business. And we are running a 2-day digital event. So the event is going to be hosted via Zoom, and we're going to be covering topics all the way from tackling debt, managing money, improving your credit score, which is important if you're going to be buying your first home or getting a mortgage. We've got a guide on that specifically. We're going to talk about generational wealth. So that's the first day. It's Saturday, which is a personal finance day. So again, it is tackling debt, managing your money better, improving your credit score, a guide for first-time buyers. This is going to be delivered by, you know, professionals in their field. So the guide for first-time buyers is going to come from a mortgage advisor. Then we're going to talk about generational wealth. On day 2, it's all about investing. So it's going to be investing in the stock market, a guide to. So a lot of the stuff that I talk about here, but in a more condensed kind of version. We've got an investment manager speaking specifically about that. Then we're going to have Tyrone, who is going to talk about investing in cryptocurrencies. That is something that I get asked a lot about. And it's not really my forte. I don't tend to speak about things that I don't really know much about. So Tyrone is definitely the guy for that. Then we're going to have someone talk about the different ways in which you can invest in property. So is it buy to let? Is it rent to rent? What is it? Is it HMOs? How do you do it? There's going to be a guide for that. Then we're going to have someone who is a property expert. He's got a multi-million-pound property empire himself. He's going to talk about how you build a buy to let portfolio by simply moving your money around in the most tax efficient fashion. Then to finish it off on the Sunday, we're going to talk about starting a business. That is something that is on a lot of people's radars. And we have a celebrity, actually, a serial entrepreneur, coming to speak about that, share his experiences and give you guys some tips. So his name is Paul C. Brunson. He's probably best known for being on Celebs Gone Dating. But to be honest, I don't think that show really kind of like does him justice, if that makes any sense. He's a serial entrepreneur. He's got his fingers in so many pies, it's unreal. So he's going to be talking on the Sunday. So how it's set up at the moment is you can buy tickets for Saturday, the Sunday, or a weekend pass. And I'm raising money for a charity that is close to my heart. Well, a social enterprise that is close to my heart. They're called the Lifehood Academy. And the Lifehood Academy basically do work with boys and girls in London, in the inner city, getting them off the street, putting them in an environment of positivity, and they give them mentors as well. So in addition to raising money for them, I've got a goal of £10,000. It's pretty big, it's pretty audacious, but that's the goal. If I don't go for it, then I'm not going to reach that goal. So that's a couple of things there. I will leave a link in the chat for you to get tickets if you're interested in that. But yes, and in addition to it, I'm going to be doing financial planning or financial education with the parents of the kids that come into the program. And I'm also going to be mentoring, I said, 2 kids I'm going to take under my wing as a mentor. But I have a funny feeling that will probably be more than that, because I find it difficult to say no. If they ask me to take 5, I wouldn't be able to say I only want to take 2. So we'll see now how that works. But I'll post the link to the tickets shortly in the chat. But anyway, let's get going with your questions if you have them. Daniel, how you doing, mate? What's your view on peer-to-peer lending over stock investing? Okay, so peer-to-peer lending is okay. You need to understand how it works, though, with peer-to-peer lending. So let's have a look at peer-to-peer lending, right? With peer-to-peer lending, you typically will be told that you can invest X amount of money and you will get X return. However, with peer-to-peer lending, what you're doing is you're lending money to businesses, right? So these could be new businesses in London, Birmingham, wherever. Now, the issue that you have with that is this. A new business only just started out. The highest period of risk that you're going to face with them is probably the first 3, maybe 5 years. So with that in mind, if you put your money into a peer-to-peer and they go and lend to a business or a bunch of businesses, there is a good possibility that some of the businesses might fail. That's just the way the world works. Now, what you want to be looking for is, if you're using a peer-to-peer lender specifically, is if you're going to give them, say, £1,000, right? What businesses are they going to be putting your money into? Are they going to be diversifying that portfolio as well? Because one thing you don't want to do, and it's the same thing when you invest, you don't want to have all of your £1,000 in one stock, right? So what you want to do is you want to have it in, a number of businesses. You want to find out if they're going to be investing in 1, 2, 3, 4, 5 businesses. Try and get a little bit of information as well, just to do your due diligence. But you have to bear in mind that you are taking a higher level of risk with peer-to-peer lending, which is why the rates often are more attractive than some of the stuff that you'll find invested in the stock market. Well, that's arguably not true, but you know what I mean. You're getting a known rate, a known return. You're being told that it should kick out this much, and the return is always going to be attractive because you are taking that extra level of risk. Darren, hearing things about the PayPoint stock. I have a stocks and shares ISA with Wealthify and a general investment account with Hargreaves Lansdown. I think I'm swaying towards using Trading 212 for individual stocks. What are your thoughts? I've got Trading 212 account and I've got a Hargreaves Lansdown account. I said it in the video this week. There are nuances between the two. With Hargreaves Lansdown, you're going to pay £12.50 for each transaction that you make. With free trade, it's completely free. So with that in mind, if you're looking at purely on cost, then trading 212 obviously wins out. With trading 212, you can buy fractional shares as well. With Hargreaves Lansdown, you have to buy full shares. So you can't go and buy half a share or 50 quid's worth of Tesla. With Hargreaves Lansdown, you literally have to spend the full 1,500 quid to get into Tesla. So if that stock is pretty expensive, or it's more than what you want to put money into in one go, then trading 212 is a good shout. And obviously you can sell as well on a fractional basis too. I just think that Hargreaves Lansdown sometimes do actually just give you a little bit more information, especially with the emails that they send you and stuff. And like the insider knowledge and insider kind of like market research that they do. Those kind of emails I find really, really useful, which is why I've got most of my portfolio with them. But I've got to admit, I hold Facebook in trading 212. The information they provide is pretty decent, so I can't really complain there. It will just be about your preference, mate. To be honest, it will just be about your preference. And again, just making sure that if you are going to be buying this stock, then do your research. Make sure that you're looking at it from an holistic point of view. It's not about the share price now. Share price now is fine, but you do need to be mindful of share price going forward. And if you think it's a stock that is going to do well, then it might be worth a punt, definitely. Okay, so good evening, mate. I put 14,000 on 212 ISA last month, make £1,000 profit. That's really, really good. Then I bought another share with the £1,000. The question is, with the profit I reinvest now, am I only... hang on a second, say this again. With the profit I reinvest now, I am only 5K to put into you're talking about the ISA allowance specifically here. So the question here is, you've invested £14,000 into a 212 ISA. You've made £1,000 worth of profit. You reinvested that £1,000 into another stock. You're asking whether you've now used up an additional £1,000 towards your ISA allowance. The answer to that is no. So with your ISA allowance, your £20,000 is a contribution. So you can contribute up to £20,000 per tax year into your ISA. You've only contributed 14,000. That £1,000 profit that you've got is not a contribution, that's profit. So you still have £6,000 essentially to contribute into an ISA. Whenever you invest into an ISA, the main thing to remember is it is a contribution limit. You cannot pay in more than £20,000. Now let's just assume that you paid in £20,000 and your investment went up by £5,000. You've still only paid in 20,000. That whatever profit, whatever growth that you get when you invest in an ISA, the profit does not count towards your contribution. So that's a really simple way of thinking of it. Just keep that in mind. So in your case, you still got £6,000 because you've only contributed 14,000. Josh, I have an LNG and a Viva. Okay, I may sell one to reduce exposure to the insurance sector. Which would you keep? That's a tough call, mate. I haven't looked at any. I would need to have a look at the companies. I need to have a look at the fundamentals behind them. I know Aviva are pretty good in terms of cash. They're very, very strong in terms of cash reserves because they back Wealthify. And one of the reasons why I talk about Wealthify so much is because they have Aviva's back it. I think it was quarter 2, 2019, they had 1.2 billion or something like that in cash. Mate, that stuff is important in terms of financial strength. So I wouldn't be able to tell you without looking at LNG to see, number one, what their share price is right now, what their share price has done over the last 12 months. And it's also about how they've actually fared in this environment where we've been in COVID as well. Is it likely to have a lasting impact on the share price? It's hard to say for these companies without really looking into it. I mean, I think the bigger question will be, why are you looking to sell to reduce the exposure to the insurance sector? What do you think is going to happen with the insurance sector long term? Again, it's really important to think long term, not short term. So the insurance sector might suffer in the next 12 months, right? But long term, what's going to happen to the insurance sector? So I'd like to know your drivers behind it, but it's hard for me to say, sell one, keep one, without knowing, number one, what your objectives are and your goals, and looking a little bit further into into the stock themselves and the companies themselves. I just think that, if you're buying companies for the long term, the short term blips or impacts in that sector, they're inconsequential. The key thing is diversification, because if you sell one and you keep one, you think that you've reduced your exposure, but all you're essentially doing then is you're actually increasing your exposure because you only have one company in the insurance sector. You've got to bear in mind diversification. So diversification is all about spreading your risk, putting your money across a different number of baskets at any given time. And the more baskets you have, the less risk you carry, because you have more baskets. If you only had, say, one, so for example, if you go and sell LNG, keep Aviva, something happens to the Aviva share price, you lose money on that basket. You've only got one basket in that sector now. Whereas if you had two or three, Aviva might go down, but LNG might go up. Someone else might go up. So you're counterbalancing. You're stacking the odds in your favor. There's a lot to think about there, mate. It's not just a simple, buy this, sell this. There are some wider things to consider. So I would say, right, is my guidance that I would give you: do a little bit of research about the companies, find out as much as you can how they fared with COVID. Has COVID had a negative impact? Are they doing anything? Are they letting staff go? What are they doing? Typically, if a company lets staff go, typically you would see the share price actually take a tick up, because it's seen as the company doing something to protect their financial future, right? So have a look at what's going on with the company, what are their forecasts, how have they been impacted, and all that kind of stuff. And if you need any further guidance, then just let me know on IG or something like that. Okay, there was another question on here. All right, Hannah, how you doing? Moneybox have a crowdfunding campaign this Tuesday coming. I know it has a high capital risk, but what are your thoughts on this? Okay, so I've actually signed up to get a bit more information on the crowdfunding for Moneybox. I'm going to do a video on that specifically, but I have looked at them very, very briefly. So they've already got investors with Moneybox, and to be honest, I mean, my video on Moneybox is, well, if you type in Moneybox, my video ranks the first on YouTube, which I have no idea how that's happened, but it has somehow. They're doing really, really well. They've got 100 million or something like that under management right now. It was something stupid when I watched the video earlier. It sounds like a good option. One thing that I'd be interested in knowing, though, is what are you going to get in exchange for the crowdfunding? There isn't that much information out there at this point in time. I'd want to know those details. So I'm on the list of people that wants to get a little bit more information, because I might even put some money into it, but I need more information to know. And yet, you're going to have higher capital risk. But then again, if you think about the company, and this is where the fundamentals then come in, and you may not necessarily be privy to this information, because if they were floated on the FTSE 100, for example, right, you would have all of their financial data. If they're crowdfunding, we're not likely to see what their financial data is. So it's okay for them to have 100 million under management. That's fine. But how much of that is coming in? How much of that results in actual revenue in terms of money coming in, turnover? Then you need to have a look at, okay, so are they in profit? Are they losing money? What money do they have going out? These are all important things. If they were floated on, the FTSE 100, you could have access to all of this information. It isn't something you should just go into just because it's Moneybox. You still need to ask, the right questions. And there are ways of getting accounts, especially if they're a registered company. These are public record. But personally, if I'm going to put money with them, I'd want more information. I'd definitely want to have a look at their accounts to know whether they're making profit, whether they're in a loss, how the company is structured, and what I'm going to get in exchange for the crowdfunding. There isn't that much information about that at the moment. So it sounds like a good punt based on the name, but I'd want a little bit more information just in terms of doing my research to make sure that, it is something that I would feel comfortable putting my money into. Okay, Daniel, what are the key areas of your research into a company after review of the Trading 212 data to understand if it's a good pick? Share price, PE ratio, revenue. Yeah, so all those things are important, Dan. But there's a lot of stuff about a company that you're not going to find in the Trading 212 account. So all Trading 212 do is they give you just company details. That's it. So for example, in Tech Pharma, great company, doing a lot of work with their accordion capsule, right? Really, really good results when it comes to treating Parkinson's disease. That information isn't on Trading 212. So you have to, if you're interested in the company, go Google stuff, go and find, right, what do they do? What products are they developing? If they've got clinical trials, how well are the clinical trials going? Listen to interviews from, by people who are heading up the company, right? You've got to do this external research. You need to understand what the company is actually doing. You don't need to know to the minutia, because you're not a professional investor. I mean, investment companies are, sitting in front of these people like every single day, like the CEOs of the business, getting into the weeds of what they are going to be doing. You need to know that detail, but you don't need to go into that 8th degree. But having a fundamental understanding of what the business is doing and how they're going to make money, how they're going to make profits, who their competition is, those kind of things, that's important. That's really, really, really important. So the fundamental, profit earnings and PE ratios, revenue, share price, that's all well and good. But a lot of the stuff that I researched for my video this Friday, that didn't all just come from Trading 212. It came from me reading articles, reading papers, and also watching some videos about them as well, and trying to get an understanding of what they're actually doing. And also, you can also get a really good indication of whether a company is in the sphere of the big investment houses just by, listening to some of the financial news. So Regeneron, for example, really, really big in terms of interest from some of the professional investors, particularly in the States. They talk very, very highly about their tech and the stuff that they're doing. So that tells you right there that actually it could be a big pick. But again, I haven't yet bought that stock because I'm still trying to figure out why their share price has risen so much in the last 12 months. I mean, one of them went from $112 to $417. It's crazy. It's really, really nuts. So I want to know why that is. Is it purely because of COVID? Because if it is because of COVID, how much value is left? If they missed the boat when it comes to the vaccine, then is the share price going to take a tumble at the back end because they were too late to the party? It's not just, you have to bear in mind actual factual information, not just sentiment. And the reason why I've not bought those two specifically, well, Regeneron specifically, is because of that one factor. It's gone up so much in the last 12 months. I might overpay. I need to do a little bit of research about that. And I need to know whether the growth that it's been experienced in the last 12 months, if it is purely because of COVID, how much more value is there? And you can't tell whether they are going to be the first, to get a vaccine. But if they aren't, possible risk. That's when it's all about making sure that you weigh up for the potential return that the share price could go to $800. Are you willing to take that punt? But for me personally, I would want to know all of that information so that I can make an informed decision. So, those things are important, but just don't rely on the information that's in Trading 212 specifically. You need to do further research and just look out for information, look out for news bits as well. Darren, can you hold and use multiple general investment accounts? You can, yeah. I mean, look, a general investment account, when I was advising, basically what we would use a general investment account to do. So financial planning, right? The first rule is tax efficiency, right? That's how we get taught stuff. That's what we study. And when we qualify, that's the first thing that we understand, tax efficiency first. So what will typically happen is we would have a look at all of your tax efficiency vehicles, so your pensions, your ISAs. And once we've used up all of those allowances, so for example, you use for £20,000 into your ISAs, we will then use a general investment account to sit some money in so that we'd invest it if we needed to. But ultimately, the money that's in that account will then go in to use your tax allowance the following year. So it's almost like a feeder account. You can hold more than one. It's not a problem at all. Okay, so Josh, you're just saying here you're happy with both, to be honest. I just felt that they just too similar to warrant having both. But you make a very good point. Most likely to hold them as they are two strong companies. Yeah, look, mate, you need to think about diversification. Having strong companies are good. I don't know if they're either of them are paying dividends, but if they're paying dividends, that's an extra bonus. So, having these strong companies in your portfolio is a good thing. You're diversifying your risk. You're putting your money into companies that are solid, that have been around for a while, that have got cash reserves. It's there to add value to your portfolio. So you just need to bear in mind the job that they're there to do. And again, this is why it comes back down to having goals in the first instance. What are you investing for? You're investing for growth. You're investing for dividends. What is it? If you're investing for growth, for income or dividends, then you're only going to go for dividend stocks. But if you're investing for growth, dividends plays a part in that, because if a company is paying dividends and they're set up, their balance sheet is going to be healthy. It plays a part in that, but it isn't the end all be all. And this is what I see people talk about all the time, that they're investing specifically for dividends. Well, that's problematic, because you look at the COVID-19 issue at the moment. FTSE 100 reporting 50% drop in dividends this year. If you're investing purely for dividends, it becomes hard. You guys won't be in the position where you are investing for dividends for income purposes for retirement. But if you did need an income from it and you're investing for dividends right now, then you're pretty screwed. So things like total return, which is basically your dividends payments and your actual returns from your investment portfolios, capital gains, is more important than dividends right now, in my view. And that's certainly the conversations that I'm having with my mates who are investment managers and financial planners. That's the general challenge that they're facing right now. Is dividend is, it's hard to come by right now, given what's happened, and we don't know how long this is going to last for. So, Umar, I have £1,000 to invest. What apps would you recommend to use? Mate, there's tons of them, mate. There's Wealthify, there's Nutmeg, there's Plum, there's Wombat, there's Wealth Simple. There are so many. It depends whether you want to invest with an app that will do the work for you. So you send them money, they do all the research, they package the investment, they diversify it for you, they manage the risk. Or you want to do what most people do and invest via trading 212. You need to know the difference between the two of them, though, because they're two different fish, right? Like, actually, one's meat, one's fish. You need to know the difference between the two of them. So you need to understand what you want to do. And again, you need to have goals. So, it's hard for me to get into the meat and bones on a live like this, but it is in my investment course. With the investment course, I try to make sure that you guys understand, number one, how to keep your money safe, because that's really important. Investor psychology, because let's face it, when markets go down, it's very, very easy to panic and be like, I want to get out. We talk about why we invest, inflation, why that's important, some investment myths. When we talk about, okay, so what should you do? Should you invest via a app that will manage it and do all the work for you, or do you go and buy trading 212 shares, right, and use that kind of engine? We talk about what you need to look at, fundamental stuff that you should be looking at if you're going to use trading 212. For example, we talk about tax, because that's, again, guys, don't forget tax. You do have tax allowances. You have a number of them, but you need to make sure that you actually keep track. Oftentimes in times where markets are going, up and down quite a bit, you'll be surprised that you can very, very quickly breach your dividends allowance. And if you miss it and you don't pay your tax, you can have HMRC on you, and you do not want that. So the course talks about that, and then it gets you to the point by the end of it that you will know whether you're going to do an app or trading 212. If you decide you're going to do an app, I give you a 90-page guide that will basically walk you through the account opening process with Wealthify. I've only chosen Wealthify, not because I've got any affiliate links with them, I haven't, but because they do have Aviva back in them, and I like the way they presented information if you watch the review. So it takes you from literally nothing to actually being able to open an account physically and get going with an investment. So that's kind of like a long-winded answer, but it's hard for me to say use this one, because there are a number of them out there and you need to pick the one that is best going to suit you. Ricky, how you doing? Done very good points. That's helped me, thanks. This may be the same as many other businesses due to COVID, not telling the full story. That's very, very true. James, I heard once that if a service is free, then you are the product. Is this the case with trading 212? How do they themselves make profit? So as far as I understand, so what you're asking there is, how do trading 212 make profits? Trading 212, as far as I understand, make most of their money from their CFD side, which is basically like the proper trading. Like that's the big boy shit, right? You need to understand what you're doing if you're going to be trading, and that's contracts for differences. That's where you're trading oil. You can be trading shares, stocks. You can be trading currencies on there. You need to understand what you're doing. That is a different kettle of fish completely. So I know that they make most of their money off the CFD side, predominantly. I think there are little ways that they make money from the trading side. I'm not sure how that is though. I've not really researched it, but most of the money comes from CFDs from what I've read and from what I've heard. The big question only, everyone's mind. In your view, do you think there will be another stock market crash this year? Oh, tough one, mate. I think if I speak to most of my mates who are investment managers and financial advisors, a lot of them are of the view that it's going to be very, very volatile. It really depends on what happens post furlough coming to an end. But having said that, you've got to think about this in sequence, right? The biggest market in the world is America. The Fed out there has committed to printing money. So I think their debt level was something like, I think it was like 2 or 3 trillion quid. They're at 9 trillion quid right now, like $9 trillion, right? So they have committed to print as much money as they need to in order to prop up the markets. Now, if you look at the US stocks market, they're almost at the levels that they were prior to COVID actually kicking off. And that's purely just been a function of the Fed printing money and propping up the market. If they continue to do that, then you could argue that the global economy as a whole should be okay. If the American market does well, then we should be okay as well. But that isn't a definite. That's just speculation. Nobody truly knows, if I'm completely honest, and it's hard to give a definite answer when it comes to that specifically. I think if you are investing in the market, it's the same story as always. Expect there to be volatility. And this is the kind of stuff that I cover on the course when I talk about investor psychology. You have to get used to it. Expect that there's going to be volatility. Expect that the stock price is going to go up. Expect that it is going to go down. That just comes with the territory, right? You cannot change that. Therefore, it's really important that when you are investing, particularly if you're using Trading 212, that you bear all of these things in mind. The fact that the market goes up and down isn't necessarily a bad thing. It actually is. It is good for investors, particularly if you're investing on a monthly basis, because you benefit from pound cost averaging. And again, I cover all of this in the course. It's the benefits. You need to be able to position yourself in a state where, number one, you're comfortable with it going up and down, but you are positioned to take advantage of market volatility. Because guess what? Warren Buffett still hasn't taken a position just yet. And if he's the best, if he's the greatest investor of all time, and he's not taking a position, that should give you a pretty good indication. The trouble is, nobody really knows what Warren Buffett is thinking. A lot of people are saying, well, we're just going to hold fire and see what happens, when Warren's going to move. But you need to understand that Warren has the luxury of having billions and billions and billions of dollars that he's sat on. And when he moves, you could argue that if he goes and buys a company, that immediately you're going to see the share price shoot up because he bought it. And because he bought it, there will be a number of other investment houses that are going to buy it as well. The key thing you have to remember is it's not about time in the market, it's time in the market. Be prepared for volatility, position yourself where you invest on a monthly basis, forget about what happens. If it goes down, it goes down. If it goes down and you invest on a monthly basis, then happy days, because you're cashing in, right? You're getting all this stock at a discount. And if it goes back up again, you're laughing, because the rule is you buy low and you sell high. So do I think the market is going to crash? I don't know, mate. There's a lot of speculation around volatility, but is it going to crash? It will depend on a number of factors. The American markets is one of them. And as long as the Fed continues to print money, I think it should be in pretty good shape. But that isn't to say that I'm right. I could be completely wrong. I know that my industry has got it completely wrong in the past, but that's just speculation at this point. Right, let's just see what else we've got here. Oh, there's quite a few questions. I've got to go back. 1 second, guys. Keep your eyes peeled for videos and sign up. Perfect. Okay, Joe. What courses would you recommend to learn more about insurance? I don't know that there are any insurance courses at this point in time. I don't know of any. That might be something that I could do, but I don't know of any insurance specific courses. It depends what you want to learn, though. You're talking about the insurance sector or just how insurance works? Because the insurance sector, the best thing you could do for that is to read, some financial sort of papers and just monitor what goes on with the insurance sector. I mean, the entire premise of the insurance sector is they are covering. It's similar to basically trading and investing, right? Pretty much, because you take out life insurance, they will cover you for critical illness, for example. And they will say, well, if you get a critical illness, we'll pay you X, you pay us premiums. And they will work out what the propensity or the possibility is of you getting the critical illnesses that they basically cover you for. And they will know that if you're aged, I don't know, say 30, for example, the chances of you getting cancer might be 1 in 5,000, right? So they are then calculating their monthly premium to cover that eventuality, because they know they got they've got a 1 in 5,000 chance of them having to pay you out said sum of money. It might be 200,000, might be 300,000 pounds. So they are doing exactly what you do when you're trading or when you're investing. They're using numbers to make an educated guess. The same thing with life insurance. They're covering you for life insurance because everyone's going to die at some point. But that's why they then put things like term assurance in there. So they only cover you for, I don't know, 10 years or 15 years, because the likelihood of you dying within 15 years, again, might be 1 in 1,000. So that it's a calculation game. This is what I'm saying. Like financial services, these businesses, they have people who, like, they know insurance. This is a prime example. An insurance company, if you go to them for health insurance, they know the likelihood of you getting any medical condition based on your age, your habits, whether you smoke, whether you drink. They know how likely you are to get a medical condition or be ill with some kind of illness better than you do. They have people who actually work this stuff out for them. This isn't, just a game of chance. This is calculated. This is really, really looked at. And this is what I keep saying. Anything to do with money, whenever you're dealing with any provider, investment, insurance, banks, anything, you have to know the rules of the game. If you don't know the rules of the game, you've got no chance of winning. So, insurance, the basic premise of insurance companies, they're covering an eventuality, an outcome in the future. And they're basically calculating the odds of that thing happening and charging you a premium to cover their downside. That's all they're effectively doing. So if you want to learn about the sector, then it will be financial news. Just get some reading, mate. Will be the best way to learn. If there's anything specific that isn't covered in there, I could probably build a course for it. It really will depend on demand, though. So, yeah. Josh, I'm a hybrid investor as such. I have some dividend stocks and growth stocks. I'm using trading with 212 for US stocks due to free trade and having a fee for buying them. I also have some ETFs for good. Yeah, I mean, ETFs are great, mate. Give you access to some pretty good indexes, and you can bundle anything into an ETF, to be honest. And it allows you to have, get in low cost. You can trade them really, really quickly. It's a good combination, if I'm completely honest. I've worked for investment houses where they'll have ETFs within a client's investment portfolio because it allows for a bit more fluidity with the way they manage funds. Anna, get into CFDs. Yeah, yeah. CFDs is not for amateurs. Like, I don't do it, and I've been in the industry 15 years. I don't do it because I know it's not my skill set. It's not my bag at all, so I wouldn't even bother. Paul, looking to open the stocks and shares ISA. I've watched a video on Nutmeg and Moneybox. and in Wealthify, which of the three, in your opinion, is the best to manage my investment? Right, okay, Moneybox, Nutmeg, and Wealthify. I can't comment on which will be the best one to manage your investment, but what I can say is, based on the review that I've done, so I've used Moneybox in the past. Moneybox are really, really good, just in terms of like, you can pay money into the account, and you can round up like your transactions because it connects to your bank account. It's really, really, really good. The returns actually that I had in there when I was using it maybe 2-3 years ago, really, really good as well. When I did the reviews for all three of these, I still think Wealthify is the best one, not because of their specific investment management. I've never used Wealthify, but what I did like about Wealthify is how they present information. If I was a complete newbie, didn't know anything about investing at all, I would feel most confident if I went to their website, looked at what they did, and the way they explain things. I'd feel most confident, making a decision with them than I would do with Nutmeg or Moneybox. If I had to rank them, it would be Wealthify, Nutmeg, Moneybox, based on how they present information, how clear they make that information, how easy it is for you to understand. Their investment management skills, I don't know. I can't comment on that because I'm not behind the scenes to be able to know what teams they've got, what research they're doing in the background. I don't know any of that. Oftentimes they won't tell you. You just have to trust they've got a research team behind them doing most of that work. Ricky, I've just got home after purchasing some silver. I felt like a huge weight was being lifted due to diversifying. Wish I'd done it sooner. I mean, look, silver, commodities like that have always been a really, really, really good diversifier. People have used it for years, and if you go into a downturn in the markets, typically they do quite well. So yeah. James, thanks for answering. Much appreciated. Really enjoy your videos. Keep up the great work. Thank you, guys. There aren't any more questions in here. I don't think I've missed any. Just double check just to make sure. Daniel, if you have smaller funds, less than 5,000, is it worth putting into an active index fund, i.e. lots of talk about ARK Investments and their management team? Okay, so this is one thing I see on YouTube all the time, and it really pisses me off. Okay, so people talk about passive versus active. Okay, the whole point of active management is that you have someone at the helm steering your investment, making decisions for you to try and get the best performance out of the situation that you're facing. Okay, so you get a professional investment manager, for example. People on YouTube have been saying for the last God knows how many years now, oh yeah, passive is always better than active because you can almost do this yourself and beat an active manager. A monkey could make money in a rising market, and we've seen rising markets for the last 12 to 13 years. A passive investment is going to be horrible in a downturn because it's passive. You haven't got anything really behind it helping to steer the investment decisions, trying to look for opportunities. So there is a time and a place for active. There's a time and a place for passive. Now, the guys at ARK, yeah, they've got a really, really good team. But the downside that you're going to have with active is you are going to pay an extra cost, which is the big thing that people keep saying, just go passive because it's low cost. It's not going to cost you anything. It's really, really cheap. This is a prime example that I always say, cheap is not always best. It depends on your circumstances entirely, what you want to achieve. But I would generally say that if you've got a small amount of money, you want to keep your costs down. So passive may help. If you go with people like Wealthify, for example, I'm not sure if it's Wealthify or not, but there's a couple of them that have the ability for you to pick an active approach. You pay a little bit more, but you can get it. But generally speaking, you want to keep your costs low. But again, it depends on your objective, right? What are you looking to achieve? Are you looking for a certain return? Are you looking to invest in certain things? It really depends. Passive might be right for Daniel, but it might not be right for Josh. it really depends on your circumstances. But generally speaking, you need to decide, mate. It depends on your goals. I would say if you're going to inquire about it, most of them will have projected returns. So just have a conversation about what their projected returns are and ask questions about how they are going to go about achieving that, or what the plan is, or how they think they're going to achieve that. With these guys, if it's an active index fund, then they will already have the companies laid out in a portfolio. So you want to be asking questions, where's the growth going to come from? How is the portfolio built? What level of risk are they taking? And how often they're going to be looking at it, because the whole idea of active is you have someone potentially looking at it almost every single day. If they're saying, well, it's an active fund, but we're only going to look at it, once a year, that's not really active. You shouldn't be paying money for that. That's for damn sure. So it really depends on your circumstances. But yeah, keep costs low. That's important, but it depends on your goals. If you want to go with them because they do have a really good team, ask the questions that I've just suggested. My money box is going well, but I'd like to have more control and build a portfolio with Hargreaves Lansdown. I don't understand how often or when I'd be charged any capital gains or tax. In general, a bit lost. Capital gains typically doesn't occur until you cash in an investment. So, for example, I've got Tesla, right? So my Tesla stock is up. It's up stupid at the moment. It's almost I think I've got about maybe 55% return on them at the moment. So I've got capital gains potentially. So if I sell my Tesla today, 55% up, then I'm going to have a capital gain on my return. But it's not physically won't have to pay any capital gains until I actually sell my holding. So typically, you'll need to sell your holding before you get charged any capital gains. In terms of tax, you would need to do a self-assessment every single year to HMRC. So if you've sold any stock, had any capital gains occurrences or anything like that, then you would do a self-assessment, and then the self-assessment would kind of tell you what tax you need to pay accordingly. But if you're just holding stocks for the long term, you're not cashing it in, don't worry about it. If you're going to be moving, trading, selling stuff to buy new stuff, then you are going to have capital gains potentially to pay if you breach your capital gains allowance, essentially. So yeah. And by the way, if you sell and you reinvest, then it doesn't matter. It's when it comes into your account that the capital gains becomes due, because that's when you have to declare it on your self-assessment. Josh, what do you think about trading 212 pies? Will you be using them? It seems a neat way of creating your own custom ETF. I can't say that I've looked at that side to it, Josh. I can have a look at it. Tell me what it looks like. When you say pies, is this their way of apportioning investments or assets within an investment? Just let me know, mate. Cool, that's fine. What's your thoughts on gold investment? Should you have in your investment portfolio? Yeah, I mean, gold is a really good diversifier. It's really just going to be about how you actually invest in gold, because you can invest in physical gold, you can invest in gold ETFs. It's all about how you invest in gold. But gold has always been a really good diversifier. Investment houses use them often to basically diversify portfolio. So they are a good shout. It's just going to be about how you invest in it and how much you put into it as well. Again, you don't want to over extend yourself or expose yourself on one particular thing. Harry, I'm 22 on 33K with costs around 8K a year, and I'm aiming to get on the property ladder as soon as possible. Would you recommend some diversified equity, or should I just stick to bonds? Okay, really good question, Harry. Mate, you're on 33 grand. You've got expenses of 8 grand a year. That's fucking awesome, mate. Seriously, you're winning. You're absolutely winning on that. Right, so this is what I would say to you, Harry. You need to know what your timeline is towards getting on the property ladder. Is it 1 year? Is it 2 years? Is it 3 years? How long is it going to be? You need to know that before you start thinking about investing in the market. Now, if you're investing and you're looking to basically make more money for your deposit, guess what? Very high risk game, mate. Very, very high risk game. I would say you should probably utilize things like Help to Buy, ISAs, lifetime ISAs. If you haven't got an Help to Buy ISA, you can't open them now. I think they closed October 31st last year, but you can do a lifetime ISA now. That will help you with a deposit. But I mean, look, I had a friend of mine who I used to work with in Canary Wharf, and he knows better. I was speaking to him 2 weeks ago, James. He said he's just bought a house. He lives down in Kent. He's just bought a house, and he stupidly went and invested his money, his deposit money, in the stock market. When COVID hit, the market started to tank. He started to panic, thinking, shit, I've got to buy a house. And he was literally on the verge of having to pay for his deposit. And he had to cash in his investment at a loss. And I was like, mate, you know better than this. He goes, I know, but I just felt like I might get lucky. It's a risk, mate. So you need to understand your timeline. How long are you looking to get on the property ladder for? Like, so are you working 2 year, 3 year? What's your timeline? Then look at other alternatives. You can do bonds. Bonds are great. Bonds are as secure as you're going to get when it comes to investing. You get a known rate from the outset, but make sure that you are using your allowances, the lifetime ISAs, that kind of stuff, because essentially that's free money, mate. You don't want to say good. You don't want to say no to that. So just bear that in mind. But don't invest your deposit money. It might seem tempting. Just don't do it, because if you need your money and the markets are down, you don't want something that you can't control dictating whether you can buy the house that you want or not, right? It's not worth the risk. And typically speaking, if you're going to be investing in the market, you need to look long term anyway. You need to look 3 years plus. So just bear that in mind. Let me just have a look and see if I've got any other questions on here. I think I've covered most with 51 minutes in. Okay, Josh, you just come back here. Basically, you can put as many stocks into a pie as you want. You set a percentage of your monthly deposit into each of the companies. Right. Okay. So basically, what they're essentially doing here is it's almost like asset allocation, effectively. So yeah, you've got a pie with 25% in this group of companies, 40% in this group of companies. It's good. It's really, really good. Again, it's all about the stock selection, though. So what companies are in there? Are you fully diversified? That's the question. It's a good way to visualize it so that you kind of know exactly where your money's going. But again, that doesn't negate the need for you to have a look at the detail, the companies that you've got in that pie. Are you well diversified within that? You know, those are things that you need to consider, and don't take that lightly, because it's really, really important that you know the detail. Do you have a live every Sunday? I discovered your channel today. Yeah, cheers, mate. I don't have a live every Sunday. What I plan to do is to do one every 2 weeks, essentially. So the next one, whilst we're on it, the next one is going to be on. The next one's going to be on the 9th of August. So that will be the next live here, where I'll be taking more questions and stuff from you guys. So every 2 weeks, that's the plan. I do want to move to like weekly, but it's a lot of work at the moment. I've got stuff going on with the event that I talked about at the top of this. So just to recap on that, look, I'm basically looking to raise money for a social enterprise in London. They take kids off the street, put them in a positive environment, and give them mentors, give them people to look up to help them, you know, steer the right path and avoid, you know, prison sentences and crime and all this stuff. And it's a big issue. It's something that's very, very close to my heart with my background and stuff. So I want to raise money for that, and I'm doing that by hosting a two-day digital wealth event. We're going to host it online via Zoom. And we're going to be talking all things personal finance and investment. So tackling debt, managing money, improving your credit score, a guide for first-time buyers, generational wealth, investing in stock market, investing in cryptocurrency, investing in property, how you do that, whether it's buy-to-let, HMO, rent for rent, how you can start to build a buy-to-let portfolio by just moving your money around, using momentum investing, moving your money around in an efficient manner, and then, you know, starting the business. So you can buy tickets to either the Saturday or Sunday or both days, and the money from the ticket sales is going to this charity. My goal is to raise £10,000, essentially. Really big goal. I've got a massive way to go to do that. But if you don't dream big, you don't make stuff happen. So that is the goal. I will put the link in here, actually, just in case you guys are interested in purchasing tickets. It would be a great help. And trust me, on the link that I put in here, you will go to a landing page which will give you information on all of the speakers that we've got speaking, all of the topics that we are going to be covering. And it also gives you ticket prices. Ticket price is like 25 quid to go for the entire day. If you want the weekend pass, it's £40 effectively. So it's bit.ly money intelligence ratio. I've got that right. So the link is in there now. If you guys feel like you'd like to attend that, please do go along and purchase tickets. But yeah, we're 55 minutes in now. So unless there are any other questions, I really do appreciate you guys spending this time with me, especially on a Sunday evening. I've got to sort the camera stuff out. I will do, but with lockdown, it's amazing that you buy stuff on Amazon and they hike the price like 300%. It's like ridiculous. So there's one bit of kit that I need to get that will enable me to use this camera, which is what I use for all of my YouTube videos, to stream online here. So guys, thank you, Paul. Really appreciate it. Thanks, Josh. If you guys haven't followed me on IG, go follow me on IG. I do take messages there as well and questions there. If you guys are interested in the investment course is amazing. The people that have taken it so far have been really complimentary about the content and stuff. It is a small investment. It's £105.97, and there's a reason for it being £105. The platform, the learning management system that it's in, cost me $100 a month. It's an American platform, so $100 a month. So I need to make sure that I cover my costs and stuff like that on there. But trust me, in terms of keeping your money safe and understand what you're doing in terms of like how investments actually work, right? How you diversify, managing risk, your tax positions, your tax allowances, just the investor psychology, all the stuff that I've learned that investment managers always use, professional investment managers use. It's all in that course for £105, and just getting that foundation. It's an absolute bargain. And yeah, I also give up a little bit of my time as well for Q&As after you've taken that course. On most of my videos that I'm speaking about investment, the link is in the description or the comments pinned on each of those. So if you go and watch the video from Friday, the link is there. Go check it out. But guys, I appreciate you guys spending the time with me. If there are no other questions, I'm going to log off. And guys, have a great evening, and I'll see you on the 9th of August. Cheers.